Welcome back to the Deep Dive. Today we're digging into Everus Construction Group, ECG, specifically their Q3 2025 numbers. And honestly, for anyone watching the specialty construction space, this wasn't just, a good quarter. It felt like a major shift, almost a re-rating. We're going to unpack how they pulled off this huge upside surprise, especially when, everyone else seems to be grappling with labor issues and costs.
Yeah, it's crucial context. You really have to remember ECG is pretty new as a standalone company. They just did that carve-out from MDU back in, 2024. So this Q3, it's really the first big proof point for their focused strategy as an independent entity. And, they didn't just execute. They executed at a scale the market clearly didn't expect.
Okay, that background makes these numbers even more striking. Let's hit the headlines first. The street was modeling around $0.62 for GAAP diluted EPS. What did ECG actually post?
They came in at $1.11. That gap alone is pretty incredible. It's almost a 79% surprise on earnings per share. You just don't see that kind of beat very often.
Wow. And the top line. Did revenue keep pace with that kind of profit jump?
It absolutely did. Revenue hit $986.8 million. That blew past the consensus estimate by over $150 million. And it represents nearly 30% growth year over year, 29.7% to be exact. Strong growth.
So not just beating expectations, but smashing them on both lines.
Exactly. And importantly, this wasn't just empty revenue growth. It was profitable growth, which, brings us to that idea of operational leverage. They're clearly converting the surge in demand, especially from data centers, into profit very efficiently. Their costs aren't scaling nearly as fast as the revenue boom.
Right. So how does that show up in the margins? What did EBITDA look like?
Okay, so EBITDA was up 36.9% year over year, coming in at $89.0 million. And crucially, the EBITDA margin itself expanded. It went up 50 basis points compared to last year, landing at 9.0%. So they're managing volume and improving profitability per dollar of revenue. That signals really tight control over project execution and costs.
Okay, so the headline numbers are, frankly, stunning. But let's peel back the onion a bit. Where did this huge outperformance actually come from within the business segments?
Well, if you're looking for the engine of this quarter, it's clearly the electrical and mechanical segment. The E&M side, that's where a lot of that big project work, like data centers, sits. E&M revenue grew, get this, 42.9% year over year.
43% growth in E&M. That is really eye-watering. And profitability in that segment, did it follow suit?
It sure did. Even better, actually. E&M EBITDA was up 64.0% year over year. That pushed the E&M segment margin up to 8.7%, which is a full 110 basis points higher than last year. It shows they're not just taking on complex work, they're executing it really well and capturing strong margins on it.
So E&M is the growth story. What about the other major segment, transmission and distribution, T&D? How did that perform?
T&D played its role perfectly. It's the stable, high-margin anchor. Its EBITDA margin was very strong at 15.1%. That was actually up 180 basis points year over year. Management pointed to a good mix of projects and just solid execution on that essential utility work.
So T&D is the consistent performer, providing that backbone, while E&M is riding this huge wave.
Precisely. You need both for a quarter like this. The stability from T&D allows them to really capitalize on the E&M surge.
Let's talk about what management said. They emphasized their 4 EVOR strategic priorities. Beyond just saying strategy, what were the specific drivers they called out for Q3 success?
Yeah, they didn't just chalk it up to market conditions. They mentioned 3 key things operationally. Favorable variances on projects, meaning things went better than planned. Efficiency gains, especially on larger projects, and something they called project pull forward.
Pull forward. So getting work done faster than scheduled.
Essentially, yeah. Delivering certain phases ahead of schedule, which let them recognize the revenue and profit in Q3 instead of maybe Q4 or later. It speaks to their execution capacity.
Okay, and you mentioned capacity. The labor piece really stood out to me. Every other construction outfit seems to be complaining about finding skilled workers. How did ECG address this?
Right, and this might be the most important strategic point they made. Management explicitly said their success in attracting and retaining qualified labor was critical, absolutely critical to hitting nearly $1 billion in revenue for the quarter. Think about that. If you can actually find and keep the skilled electricians, the pipe fitters needed for these huge, complex data center jobs.
You've got a major advantage.
Exactly. It's a massive competitive moat. It allows them to confidently bid, win, and then actually execute on projects that smaller players just can't staff up for.
Makes sense. Okay, let's look forward a bit. Balance sheet and backlog. After putting up such a huge revenue number, is the pipeline still looking healthy?
It is, and this speaks to the sustainability of the momentum. The total backlog is sitting at $2.95 billion. Now, considering how much revenue they just burned through in Q3, the fact that the backlog is still up 6% since the start of the year, that's pretty solid. It suggests good visibility heading into 2026.
And the balance sheet.
Yeah.
How much flexibility do they have?
Oh, it's exceptionally strong. Net leverage is really low, about 0.5 times trailing 12-month EBITDA, half a turn of leverage, and they have around $340 million in liquidity available. So yeah, they have significant financial firepower for organic growth and for potential M&A. Lots of dry powder.
Right. M&A. We'll come back to that. But first, the guidance. This is where things get really interesting, isn't it? They didn't just nudge the full year 2025 outlook higher. They seem to have reset expectations significantly.
It's a huge step up. For the full year, they raised the revenue guidance to a range of $3.55 billion to $3.65 billion. That's up from $3.3 to $3.4 billion previously, so a big lift.
Okay, and the profitability, EBITDA guidance.
Even more dramatic there. Full-year EBITDA is now guided to $290 million to $300 million. That's up from their prior range of $240 million to $255 million. A massive increase in expected profit.
So if you look at the midpoint of that new guidance, what does that imply for year-over-year growth?
It implies roughly 26% revenue growth and a stunning 40% growth in EBITDA for the full year 2025 compared to 2024. Management is effectively saying, look, this higher level of performance, this is the new baseline for the business.
40% EBITDA growth. Okay. But there was a small caveat in there, right? Something about Q4 margins.
Yes, and it's an important nuance for analysts. Management did note that the revised full-year guidance implies a Q4 EBITDA margin that's actually below the average margin they've achieved so far this year. Now, they weren't signaling trouble. It seemed more like managing expectations. They framed the slightly lower implied Q4 margin as a sort of good starting point for thinking about 2026. Essentially acknowledging that Q3 had some exceptional benefits, like that project pull forward, that might not repeat every single quarter. It's a way to de-risk the 2026 outlook before they formally guide it. Conservative? Maybe.
Got it. So setting a potentially conservative bar for next year. Let's connect this back to the macro environment. That E&M strength, it's all about data centers, isn't it?
Pretty much. Management was very clear on this. They said demand is very strong with no signs of weakening. And they highlighted this sense of intensified urgency from clients to get this infrastructure built. Now, this isn't just a temporary boom. It feels like a fundamental shift driven by AI, cloud computing, you name it.
And ECG seems well-positioned geographically for this.
They specifically called out strength in the upper Midwest, Midwest, Southwest, and the Pacific Northwest, key data center alley regions. And like we discussed with labor, having the footprint and the workforce to handle massive, say, $100 million electrical contracts in those areas is a huge differentiator.
Right. And this data center build-out also fuels the T&D side.
Absolutely. It's a double benefit for ECG. All those data centers need massive amounts of power. That drives the need for huge upgrades to the grid, new transmission lines, bigger substations, modernizing the local distribution networks. So T&D gets this multi-year tailwind, not just from data centers, but also from electric vehicle adoption, industrial plants coming back onshore, and general grid hardening efforts like undergrounding power lines. It creates really durable demand backdrop for their T&D services.
So putting it all together,
Yeah.
strong execution, massive secular tailwinds.
Yeah.
How has the market reacted? How's the stock done?
Well, the market has definitely noticed. Over the past month, ECG's total return was about plus 22%. Compare that to the S&P 500 at around 4.3%, or the industrial sector ETF XLI at maybe 1.9%. So, yeah, significant outperformance. The market seems to be buying into the idea that this higher level of execution is sustainable.
Okay, that sets us up perfectly for our not financial advice segment. Time to take all this analysis, the strong performance, the clean balance sheet, the M&A talk, and spin out an outrageous but plausible trade idea.
All right, so the core thesis here revolves around capital allocation. ECG has explicitly said their M&A pipeline, their funnel, is broader and deeper than before. And as we mentioned, they have the firepower. 0.5x net leverage, about $340 million in liquidity. That positions them perfectly for what they called a meaningful acquisition. They could use it to expand geographically or maybe deepen their service offerings in either E&M or T&D.
So while competitors might be constrained, ECG has the cash and the borrowing capacity to actually get bigger and stronger right now.
Exactly. They can play offense. So the trade idea is a pair trade, building on this story. The thinking is ECG is likely going to use that balance sheet strength soon, maybe Q4 this year, maybe Q1 next year, to make a significant bolt-on acquisition. Doing that would lock in even more scale, more capacity, particularly to serve that booming data center market, and it just widens their competitive advantage.
Okay, so what's the specific pair trade?
The trade is go long ECG, go short. A peer company that is, let's say, heavily reliant on more traditional, non-diversified regional commercial construction. The rationale is this. The construction market is splitting. You have companies like ECG with the scale, the specialization, and the balance sheet to win these huge multi-year data center and utility infrastructure contracts. Then you have other, maybe smaller or less specialized peers who are more tied to the ups and downs of local commercial building, maybe lack data center exposure, and don't have the financial flexibility to consolidate or invest. You're betting that ECG, the consolidator with secular tailwinds, will continue to outperform while the more vulnerable regional player potentially struggles or gets left behind.
Got it. A bet on scale, specialization, and balance sheet strength in a bifurcating market. Makes sense. So to wrap things up, Everus Construction Group delivered, well, just a monster quarter. A huge beat driven by incredible execution, especially tapping into that data center momentum. They've effectively established a much higher baseline for revenue and profitability, really validating their move to become a standalone company.
And just to reiterate our standard disclaimer, everything we've discussed is based on analyzing the company's public statements and earnings call. It is absolutely not investment advice. You need to do your own research and consult with a professional before making any investment decisions.
Right. And here's a final thought to chew on as we close. Management said that implied Q4 margin as kind of a baseline for 2026, maybe a bit conservatively. So the big question is, with these data center tailwinds seemingly getting stronger and the potential for a significant M&A deal using that $340 million war chest, could ECG actually push margins back up towards these exceptional 2025 levels sooner than management is letting on? That interplay between organic growth and strategic acquisition could be the key thing shaping the story and the stock over the next couple of quarters. Something to watch.